The inclusion of GST in a financial model, or sales tax or VAT depending on your region, requires the recognition of the balance sheet and cash flow statement impacts of these taxes. For the purposes of this video, we'll be looking at an Australian example model, so we'll focus on GST, but the principles are very similar for sales tax and VAT, but for the rates levied and the fact that sales tax is levied on only revenue, while GST and VAT are both levied on profit. When your historical GST information is brought into your financial model from your accounting package, your historical GST payable is brought into the historical balance sheet within the current liabilities section above corporate tax payable. And if we scroll across our time series to our last historical period of June 2022, you can see that we have a closing GST payable balance of 113.6. When forecasting GST, this is handled on the taxation sheet and is located below payroll tax if it's included in the chart of accounts you've chosen. Before diving into the details, let's first look at the financial statement impacts of GST. Probably the most important thing to note is that GST does not directly impact the income statement, as revenue and expenses are reported in the income statement exclusive of GST. This means that the revenue and expenses reported in the income statement will be lower than the cash impacts of these items on the cash flow statement, which will include the GST that's been added to them. For example, if a business issued an invoice for $100 excluding GST of 10%, and this invoice was paid in cash during the period, the amount received would be $110 including GST payable of $10. So while $100 of profit is reported in the income statement, $110 of operating cash flow is reported in the cash flow statement, which is comprised of $100 of cash receipts and $10 of GST collected and payable to the tax body. If this was sales tax, this would be the end of it, but because GST is levied on profit, not revenue, the net GST payable also takes into account expenses. In this case, $50 of expenses results in a GST assessable profit of $50 and GST payable of $5 at a 10% GST rate. Note importantly that GST does not impact the net assets of the business because the net GST collected is reported as a GST payable liability within the current liabilities section of the balance sheet. In this way, the inclusion of GST in a financial model directly impacts only the balance sheet and the cash flow statement. But these impacts can be significant given that GST is levied on all invoices but paid periodically. It should be noted that when GST is included in a financial model, debtors and creditors balances will include the GST payable component of the invoices and bills to which they relate, making them higher than they would otherwise be in a financial model not including GST. Regardless of this, there is still no impact on net assets. So, in summary, the direct financial statement impacts of GST are the inclusion of GST payable within the current liability section of the balance sheet and increase in GST payable within the other operating cash flow section of the cash flow statement. Looking at the top of our GST analysis, in this example, a June tax year end has been assumed with 100% of the opening GST payable of 113.6 being brought in from our historical balance sheet, assumed to be paid in the first forecast period of July 2022. The periodic GST payable assumptions are then used to calculate the forecast GST payable and paid by the business. In this example, quarterly GST assessments, a 10% GST rate, and a cash assessment basis have been assumed, with GST payments being made in the month after the end of each GST assessment quarter. The assessment of GST on a cash basis means GST liabilities are calculated based on invoices and bills received and paid in cash, rather than when they're sent out or received. This assessment basis is often used to avoid GST being paid on invoices before they're received in cash, and requires some additional analysis in the financial model to estimate the cash receipts and payments. The next couple of sections within the GST analysis allows for the specification of which revenue and expense items are GST applicable. A common example of non-assessable revenue in Australia is international revenue, which is usually GST free. Note that in this example, cost of goods sold has been assumed to be not GST assessable because the financial model includes inventory purchases, which is when GST would be paid for the inventory that is driving the cost of goods sold. The GST assessments analysis is then used to calculate the GST payable and paid of the business based on the applicable revenues and expenses and assessment assumptions. If using an accruals assessment basis, this is calculated by applying the GST rate of 10% to the net applicable revenues and expenses in each period. For example, in September 2022, 47.5 of net GST payable is forecast to be created during the month. If using a cash assessment basis, the cash basis net GST estimate analysis then calculates the net GST on applicable forecast cash receipts and payments, accounting for the assumed average cash receipt and payment delay days. In this example, although the cash assessment basis has been assumed, the cash receipt and payment delay days has been assumed to be zero in all periods, so forecast revenue and expenses will equal forecast cash receipts and payments. As a result, net GST payable per period is the same on both the cash and accruals basis. That is 47.5 in the September 2022 month, for example. Finally, for our quarterly assessments, we then take the sum of the 3-month period, which for the September 2022 quarter gives a total GST payable balance of 69.6, with this being paid in cash 1 month later in October 2022. This is also summarised at the bottom of the analysis within our summary section, where we can see the quarterly cycle of assessments and cash payments, a mechanic commonly referred to as a sawtooth. The analysis above our summary section contains the calculated GST inclusive revenue and expenses of the business, which flow into other analysis areas within the financial model, including debtors, creditors, inventory payables and capital payables, so that their balance sheet balances include their GST components. If we want to see these impacts on the financial statements within our model, we can head back to the table of contents and activate our financial statements. Firstly, looking at the balance sheet, we can see our GST payable balance in our current liabilities. If we scroll across our time series to our forecast month of September 2022, we can see our closing balance of 69.6 decreasing to negative 13.1, or a GST receivable of 13.1 in October 2022. Then scrolling down to our cash flow statement, if we expand the increase in GST payable section within our operating cash flows, we can see an increase in GST payable of 47.5 during September 2022, with our quarterly GST payment of 69.6 in October 2022, reflecting the payment of our GST payables balance from the end of the September quarter. Above this, we also have our GST receivable of 13.1 from the October 2022 month, which matches the closing GST payable balance of negative 13.1 on the balance sheet. So in summary, the inclusion of GST or sales taxes or VAT in a financial model requires the impacts of these taxes to be included within the balance sheet and cash flow statement, but has no direct impact on net assets. And from a financial statement impacts perspective, GST is reported via a GST payable current liability in the balance sheet, which is offset by the increase in GST payable reported in the operating cash flows section of the cash flow statement.